Since the big crash in 2020, the market has rebounded and hit new records, with the S&P 500 climbing above 4,000 points for the first time ever. But here's the big question. How long can these sky-high prices last before we see another crash? To get some answers, we're turning to the wisdom of the world's greatest investor, Warren Buffett. This guy has seen it all, from epic bull markets to long stretches of stagnation. And he's got some amazing insights on why the market behaves the way it does. So, why should you care about all of this? Because understanding these market trends can help you make smarter decisions with your money. Whether you're an investing newbie or a seasoned pro, knowing what drives these ups and downs is key. Stick around and let's learn how to ride this financial roller coaster with confidence, just like Warren Buffett. Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. Since the pandemic crash, we've seen an incredible recovery. The S&P 500 has been hitting records high, soaring past 4,000 points and recently even climbed over 4,500. The Dow Jones and Nasdaq have also reached impressive levels, with the Dow topping 35,000 points and the Nasdaq hitting new milestones. But with all this growth comes a lot of volatility. Every day feels like a new twist in the plot with ups, downs, and everything in between. The big question on everyone's mind: how long can this last before we see another big dip? Let's dig into some numbers. Recently, the S&P 500, Dow Jones Industrial Average, and Nasdaq have all posted strong performances. We've seen some dizzying peaks, like the S&P climbing over 4,500 points, and the Dow topping 35,000, but it hasn't been a smooth ride. There have been some sharp drops along the way, reminding us that the market is anything but predictable. In fact, just when things seem to stabilize, a sudden sell-off or a surprising earnings report can send the markets tumbling. Right now, we're in one of those moments where the market is trying to find its footing, amidst a lot of uncertainty and mixed signals. What's driving all this craziness? Well, the economy is in a pretty unique spot. We've got solid GDP growth and a bounce back in employment rates, which are great signs of recovery. But then there's inflation. It's been running hotter than usual, making everyone a bit on edge about rising prices and costs. The Federal Reserve has been tweaking interest rates to keep inflation in check, which has a big impact on how investors feel about the future. And let's not forget the global events shaking things up. From political shifts to supply chain issues, all these factors are creating a mix of optimism and caution in the market. Investors are watching closely, ready to react on any new developments that could tilt the balance one way or the other. Let's turn to the wisdom of Warren Buffett, the legendary investor who has seen it all. Buffett's analysis of the 20th century's market performance is a masterclass in understanding the bigger picture. He emphasizes the importance of focusing on long-term trends, rather than getting caught up in short-term volatility. Over the past century, the stock market experienced significant bull markets and prolonged periods of stagnation. For instance, from 1948 to 1965, the market surged, while from 1965 to 1981, it essentially went nowhere. Yet, through all these ups and downs, the overall trend was one of growth, driven by the steady improvement in the US economy and increasing GDP per capita. Buffett's key takeaway: patience and a long-term perspective are crucial for investment success. Fast forward to today, and we can see the same patterns playing out. The market has experienced massive gains since the 2020 crash, reminiscent of past bull markets, but with the potential for future volatility. Buffett has remained consistent in his approach, focusing on fundamentally strong companies and avoiding speculative bubbles. Recently, he has been vocal about the risks of overvalued tech stocks and the importance of investing in businesses with solid long-term prospects. His actions speak louder than words. Buffett's Berkshire Hathaway has been making strategic investments in sectors like energy and traditional industries, highlighting his belief in tangible value over hype. In these turbulent times, Buffett's insights remind us that staying grounded and focusing on the long term can help navigate the market's inevitable twists and turns. Today's investors are heavily influenced by social media and the ease of trading platforms, leading to behaviors reminiscent of past market exuberance and fear. Retail investors in particular have significantly driven market trends, often chasing short-term gains instead of focusing on long-term value. Warren Buffett advises against this, emphasizing the importance of investing in companies with strong fundamentals and avoiding the allure of high-flying stocks without solid financial backing. Amidst the tech boom, there are still plenty of opportunities in undervalued or overlooked sectors, offering a chance for savvy investors to make strategic long-term investments. Understanding investor behavior and market dynamics is crucial, but it's also essential to look at historical examples to draw contemporary lessons. Just as individual investors can be swayed by short-term trends, institutional investors, such as pension funds, can also exhibit varying levels of confidence depending on the market climate. For instance, in the 1970s, pension funds fluctuated between heavy stock investments and cautious conservatism, often reacting to recent market performance rather than long-term fundamentals. This pattern continues today, with some institutional investors increasing their stock holdings in the face of optimism, while others remain wary of potential downturns. The importance of temperament in investing cannot be overstated, especially in today's volatile market environment. Maintaining an objective and detached approach helps investors navigate through speculation and emotional decision-making. Warren Buffett has always championed the value of staying grounded and patient, focusing on the intrinsic value of investments rather than getting caught up in market hype. This disciplined approach is especially relevant now, as market fluctuations test the resolve of even the most experienced investors. By learning from past market cycles and maintaining a steady hand, both individual and institutional investors can better position themselves for long-term success. Building on the understanding of investor behavior and historical market dynamics, recent events have highlighted the recurring phenomenon of bubbles and corrections across various sectors. The cryptocurrency market, for example, witnessed a staggering rise followed by a sharp correction, reflecting the volatility and speculative nature inherent in emerging assets. Similarly, tech stocks have shown dramatic fluctuations, reinforcing the need for sustainable business models over fleeting market enthusiasm. These events underscore Warren Buffett's timeless advice to prioritize the intrinsic value of companies and steer clear of speculative frenzies. By maintaining a focus on solid fundamentals and resisting the allure of short-term gains, investors can navigate market bubbles and corrections with greater resilience and long-term success in mind. In conclusion, while short-term market fluctuations may grab headlines and induce volatility, the overarching outlook for the market remains optimistic. For those who adopt a disciplined approach, embracing Warren Buffett's principles of value investing, focusing on companies with strong fundamentals and sustainable business models, provides a solid foundation for weathering uncertainties. By keeping a steadfast, long-term perspective and avoiding the temptations of speculative fervor, investors position themselves not only to endure market cycles, but to thrive amidst them. Ultimately, the key to sustained success in investing lies in understanding that markets ebb and flow, but quality investments endure. As we look ahead, maintaining a balanced portfolio, staying informed about economic trends, and continuously reassessing investment strategies will be essential. By adhering to these principles and remaining patient through market ups and downs, investors can cultivate resilience and build wealth over the long term. Remember that successful investing is a journey, not a sprint. By focusing on long-term goals and fundamental analysis, investors can navigate the complexities of today's market with confidence. Whether you're a seasoned investor or just starting out, Warren Buffett's timeless wisdom reminds us to stay disciplined, patient, and focused on value. Thank you so much for watching. If you've enjoyed these insights, be sure to hit that like button, subscribe for more updates, and drop your thoughts in the comments section below. Let's rally together on our investment journeys and create a community dedicated to smart and prosperous investing.